Hello, I'm Jingjing Huang, Credit Product Strategist. Welcome to our quarterly Asia Trade Floor Update. Joining me today is Portfolio Manager Stephen Chang. Stephen, China's economic troubles have been making headlines recently. Premier Li Qiang has said that China is at a critical stage in its economic recovery. What is PIMCO's outlook for China? Is it still on track for its GDP target?
We believe China's 2023 GDP growth target of 5% will not be difficult to achieve, given its very strong first quarter growth. But its post-COVID reopening momentum appears to be fading. The loss of consumption growth momentum amid an already weakening export sector and a fragile property market argues for more government support and stronger stimulus measures in order for confidence to return among consumers and the private sector. However, we believe any near-term credit or fiscal easing in China will likely be targeted and modest.
A significant proportion of China's GDP, some estimated were as high as 30%, used to come from its property sector and the related industries. Do you think the latest support measures announced are enough to reignite the sector's growth?
We think the current accommodative policy environment in China's property sector will continue until it sees a sustainable recovery. However, the impact of the demand stimulus has been offset by low home buyers' confidence, weak property price expectation, and property construction risk due to defaults in the sector. Recent property sales recovery data have been lackluster, and property-related construction activities have slowed down across the board. In our view, a better macro outlook and greater income security are necessary conditions for sustainable sales rebound. We continue to expect a bumpy path to recovery ahead.
As China and much of the world faces challenges in economic growth, investors are increasingly turning their attention to Asia's emerging markets for resilience in navigating market volatility. Where is PIMCO seeing opportunities?
Economic growth in India is expected to outpace that of China this year and next, with Indonesia following closely behind in third place among major economies according to the latest OECD Global Economic Outlook. Over the secular horizon, we expect real GDP growth for India at 6 to 7% and Indonesia at 5 to 6% due to continued reform-oriented governance and macro stability. The younger population, in contrast to an aging China and developed countries, make them ideal for reaping the demographic dividend. For India, the renewed manufacturing push, production-linked incentives, and closer ties with the US position it as the top destination for the China Plus One strategy. India's focus on becoming self-sufficient and its strong digital infrastructure make it a leader in services exports and public digital infrastructure. Additionally, India's energy transformation agenda, particularly in solar energy and green hydrogen, is expected to drive further growth. Indonesia's growth potential lies in downstream processing of its natural resources, replicating the success it has seen with nickel. It is also well positioned to become the Southeast Asia hub for electric vehicle ecosystem and has plans to develop tourism with its 5 New Balis initiative.
So how can investors tap into the India and Indonesia growth stories?
Amid global challenges, both countries have demonstrated institutional stability and political resolve, managing inflation and supporting growth through fiscal and monetary policy coordination. Both their central banks have implemented measures to curb currency volatility and manage fiscal financing. Despite these positive developments, we believe currency valuation have not fully reflected them. Given favorable cyclical developments, steady interest rate and credit profile, we see scope for currency appreciation and growth outperformance, along with increased capital inflows. The 2024 elections in both countries pose a potential key risk, but policy continuity is broadly expected.
Looking more broadly across the Asia region, where else are we seeing opportunities?
Thematically, we are seeing select opportunities to capitalize on the cyclical recovery of the COVID reopening across the region, particularly in service sectors. Overall, we believe inflation is not a problem for most of the Asia region, with a number of central banks pretty much done with tightening and perhaps reaching their inflation targets by the end of the year. We believe Asian markets may offer better upside potential given their more stable macro condition versus Western developed markets, which are seeing higher volatility in growth and inflation. Companies in Asia are not facing the same pricing power swings as those in developed markets, suggesting that their margins could be more robust and their earnings growth and credit metrics more secure.
Similar to what you mentioned, in the broader context of global economic growth, IMF also forecasted that Asia will contribute about 70% of the global growth this year. It's a much greater share than in recent years. Well, thanks, Stephen, for your thoughts today. And thank you for watching. Goodbye.